everyone, welcome to Pro Trader Strategies Market Commentary for Thursday, September the 3rd. I'm Eric Wilkinson, and you very well may recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, and how that all comes in to impact the overall markets with my market analysis. And I do the same thing in these daily market commentaries, but I go a bit further. Based on that market analysis, I have option strategies and guidelines for you guys specifically to follow in order to implement a strategy around those assumptions we come up with. It's not going out there and picking a strategy out of a hat on a given day. I don't have a favorite option strategy. Why? Because our assumption leads us down the road looking into the devil of the details as to what option strategy we're going to implement around that assumption. So without further ado, let's get on with the economic data across the pond. We got a little bit of more insight as to the PMI, Purchasing Managers Index. Now we're getting into the service sector. Now remember, across the pond, they look at the flash estimates. We're just looking at this PMI number. It's not their major numbers, but they all pretty much came in line with expectations. Italian services came in lower than 50, but across the board, Spanish came in services below 50, but the major areas of Europe, France, Germany, and Great Britain all coming in above 50 and better or very close to in line with expectations there. European retail sales did come in much worse than expected at negative 1.3%, expected to be a positive 1.3%, and they revised last month's number down just slightly by a few tenths of a percent. All right, here in the United States, unemployment claims 881,000. Normally that would be a dismal number, but we're seeing that number go below 1 million, which is a nice thing to finally start to see, as that number was really just through the roof. Remember, at one point in time, we were seeing that number in the 6 millions. Now it's going below 1 million. It was expected to be just slightly below that, but it did finally go below 1 million there. Non-farm payroll productivity coming in at 10.1%, expected to be 7.3%. So that not really a great thing. That's the a little bit higher is not good. We want to see lower non-farm productivity. Therefore, we also got unit labor costs coming in lower than expected at 9%. We want to see those labor costs go up. That means people are being hired, right? That shows that there is demand for the worker. One thing we did note, remember when we saw these manufacturing numbers, is that we were seeing a lot of this kind of become autonomous, and that is being reflected here in the unit labor cost as we're seeing the manufacturing sector go up. Well, we're not seeing labor costs go up necessarily. Some of that also has to do with when there's this much unemployment, anybody is willing to take a job, right? They'll take a job for whatever the employer is willing to pay them. It might be much less than what they are accustomed to, but they need a job and they are competing with a big pool of people. So they don't have a lot of demand, wage demand, or it's a kind of a seller's market rather than a buyer's market in a sense. Actually, it's a buyer's market rather than a seller's market. Sorry. All right. Here in the United States, though, we did get our services PMI, and it is the Institute for Supply Management. So that is our major economic data point that we're going to be looking for as a forward-looking data point. That came in at 56.9, expected to be 57. Above 50 is expansion, and that was in line with expectations. Pretty good. So, pretty decent economic data other than the, unemployment numbers. Those didn't really, the non-farm productivity stuff. But we're going to see our major number tomorrow, and that is for the non-farm payroll, unemployment rate, all of that stuff. Those are the major economic data points for that, and that comes out tomorrow. So what are we seeing across the board? Equities just falling on their face today. It is almost a rush to the exits. Now that's ahead of tomorrow's big economic data point, but I think it's a lot of these weaker hands that got into this market a little bit later. Maybe a bit of a sector rotation as the NASDAQ, we're seeing a little bit more weakness than across the rest of the equity spectrum, but that's something we've been talking about. Is there going to be a sector rotation coming up? And it could be what we're starting to see, but I think it's really more the weaker hands getting out in masses, in a sense. And then we have the algos on top of it that exacerbate that problem. Here, the gold, I would have expected gold to get much more of a bounce here with those equities down, but we're seeing them only down about 6 points. I think that we might see that go into positive territory by the end of the day if we continue to see this weakness in the equities. Bonds almost up a point on the day. As you can see, we're up 26 ticks. 32 is a full basis point. Now, this market right back to the point of control, which I've talked about. It should want to stay between this 177-ish area and the 183. And I think we're going to continue to see that as we're hearing the Fed say that they are not going to lower interest rates. VIX spiking today by almost 4 points back into the 30s. And that's because here's what we're seeing in the equities. We've got the Dow Jones Industrial Average off 2.25%, off 650 points on the day, off of the lows, but we are below right now that 9-day simple moving average, which shows short-term weakness if we settle below there. NASDAQ off 583 points, off almost 5% at this point, came down and tested that trend channel that I've been talking about back into the regular trend channel that I've set up after this recovery has started to happen. But we are really coming back in line here. Yesterday made a nice doji. Remember I talked about even if we finish near the highs, that doji, the way it was set up, was going to look like a topping pattern. Well, today we've got that confirmation. I didn't add any negative deltas ahead of that, but at the end of the day, you can see that now we've got a confirmation. So are we going to see some more correction here, or are we going to start channeling in this old trend channel here? Pretty narrow compared to what we've been accustomed to on the ranges that we're seeing now. E-mini S&P's off just better than 3%. 111 points on the day. We'll take a look at the breakdown. Just will give you an insight as to what's happened overnight. Pretty flat as that over the economic data points across the pond came in pretty decent, but then we just started seeing some weakness head into today. I think this is more of a non-farm payroll ahead of tomorrow's payroll numbers that really caused this weakness. And the ISM was not really able to, which is the service, the ISM non-manufacturing is the service, and that's usually what we attribute the United States GDP to, is service rather than manufacturing. It didn't hold off at all, and we've got one green candle in this, so very weak today. And with that tech sector, falling out of bed, a lot of those companies really getting beat up today. I'm kind of hoping that we can see that the Dow Jones, some of these blue chips, can hold on to it. That would be very good signal that there is sector rotation going on here. I think one of the few stocks that were up on the day was like Johnson & Johnson, not Johnson & Johnson, JP Morgan and Beyond Meat were a few that were positive on the day. Mine's pretty red on my portfolio, but that's because it's an overall sell-off here in the markets, but would like to see some of this sector rotation, see some of these blue chips at least, and maybe even some of the small caps get a boost as the tech sector starts seeing some weakness. That tech sector is kind of due for a bit of a correction, so I'd like to see more of a sector rotation and make this more of a healthy sell-off rather than just a free fall. All right, so let's talk about what that tech sector, me and my Intel, I decided to get out of when I started seeing this whole thing start to fall apart. And if you guys remember Intel, I had originally started selling some puts in there, sold some puts at the 45 level, bought the stock at 51.27. While we were on air live, I bought those at 51.27. Covered the puts, but I overall lowered my cost basis in the stock that I own. I bought at 51.27, right? And then I sold some puts at the 45 puts for a 43% or 43-cent credit, and then did it again for a 65-cent credit. Overall lowering my cost basis because I bought them back. by about 90 cents there. And if you guys remember, I did it again with those 45 puts where I sold them at 49 just a couple of days ago. I bought those back today for 55 cents and covered my stock at 51.37. So overall on this trade, 90-cent winner over the course of about a month. So, stayed mechanical with it. But with this tech sector rotation, I decided to get out of Intel. It's still got those woes on their 7 nano chip. So, they haven't really sorted that whole thing out. And this is probably going to be one that gets kind of beat up for that as there's a rush out of that tech sector. I just didn't want to be involved in that, despite the fact that I think it's a good company. Intel Pentium chips are, best in breed. But, decided to take my chips off the table in Intel for a 90-cent winner, which that's why we stay with that. Did you want just a 10-cent winner on a stock that you've been with for a month and a half? No, what we're doing is staying mechanical and lowering cost basis, keep ourselves in the game. And with selling those 45 puts consistently over time, I was looking at the dollar cost averaging. Also, if I didn't get that dollar cost average, then I got to keep those puts. It's like an extra dividend in Intel. All right. So, and I also did get the dividend there. So all things being good, with that, I decided to pull out of that. One thing I'm going to be looking at for today's webinar is, again, BABA getting back into it. Yesterday, we got that topping pattern. I talked about it in the daily market commentary and even in a guest spot that I did as a webinar. Yesterday, we were talking about BABA and that topping pattern, looking for confirmation. Well, it's got that. And I think that with today's short call webinar, I'm going to get great strike location because you can see we got another spike in volatility. And I think that that's going to allow me to get, or I know I've already kind of looked at it, it's going to allow me to get much further away than that 300 strike, which I would still be looking at as a short call spread. I'm going to be able to get up at around the 345 area for this type of trade. So we'll talk about the benefits of doing a short call versus a short call spread. Supposedly it has higher risk, but I'm going to talk to you about the probabilities, and are the probabilities better by using a short call versus a short call spread, and why? All right, so please check that out. Go to protraderstrategies.com. Also, finally, take a moment to go over our disclaimer. We're not trying to solicit you guys to buy or sell any of these strategies that I'm doing, or stocks or underlyings. What I am trying to do is show you how to implement options into your portfolio to increase your success rate and your profitability. This is the best way to increase that overall yield. If you go out there and just buy stock like Intel and hold on to it for a month, you might gain 10 cents like we did here, or like I did, I should say, not we. But overall, by staying mechanical, that made that better than a 90-cent winner over that course of that month, including the dividend. So that's how we do it. All right. That's the way to increase that overall yield in a portfolio. You're not just beholden to buying stocks and holding on to those. All right. So check that out at protraderstrategies.com. Also follow us on Facebook. We throw a lot of content out there for you guys, so you can take advantage of that too. All right. So if you can't take that, take it easy.